Listen carefully, because what I am about to explain can completely change how you think about investing. I built success by understanding value deeply, recognizing opportunity during fear, and acting decisively. Today, I am going to share the 2 stocks I would buy without hesitation, not later, not after clarity, but right now with fresh capital available. Before I go deeper, I need you to do something important if you truly want to think like a serious investor instead of a casual market participant.
If your goal is real wealth built over time, not speculation or shortcuts, then you should subscribe to this channel right now.
Join this community, because what we discuss here is based on fundamentals, discipline, and long-term thinking, not empty promises or trending social media noise. This is about real businesses, real cash flow, and strategies that work across decades, not overnight ideas that disappear with the next market cycle. I want to know you are serious, because serious investors commit to learning, patience, and consistency. Now, let me set the stage clearly, because we are living in one of the most confusing economic environments many investors have ever experienced. People are worried about inflation, interest rates, recessions, and constantly changing narratives that dominate financial media every single day. And honestly, I welcome that fear, because fear creates opportunity for disciplined investors who understand how markets actually reward patience. When everyone else panics or freezes, that is exactly when smart capital quietly positions itself for long-term gains. Fear is not something to avoid in investing. Fear is something to use when others let emotions override logic. Most people misunderstand investing completely, thinking it is about luck, predictions, or gambling on short-term price movements. Real investing has nothing to do with luck, because luck disappears when decisions are repeated consistently over long periods. Investing is about identifying companies that generate real cash, protect margins, and operate with durable competitive advantages.
It is also about buying those businesses when they are ignored or discounted, not when excitement has already driven prices higher.
Over the years, I have evaluated thousands of companies, which quickly teaches you what separates durable businesses from fragile ones. You learn that strong fundamentals matter far more than stories, trends, or temporary excitement.
Disciplined management and shareholder focus. These are not speculative ideas or unprofitable concepts promising revolutionary futures without evidence. These are established businesses with real earnings, real accountability, and proven ability to perform through multiple economic cycles.
Let me ask you something honestly, because this separates professional investors from amateurs very clearly. When was the last time you carefully studied a balance sheet instead of just checking recent price action? When did you last analyze valuation multiples, free cash flow, or dividend sustainability before buying a stock?
Most people never do this work, choosing instead to follow television commentary or online opinions without accountability.
That approach is not investing. It is noise, distraction, and emotional decision-making disguised as participation in the market. My goal today is to remove that noise and give you the same framework I would share with people closest to me. I do not waste time on poor investments, because both time and capital must be protected and deployed intelligently. Every dollar I invest must generate returns, produce cash, and grow over time. Otherwise, it gets replaced by a better opportunity. One principle sits at the core of my investment philosophy, and you need to understand it clearly. I strongly believe in dividends, and a company paying dividends must generate actual cash consistently, proving its business model works in reality. In volatile markets, dividends provide income, stability, and confidence when prices fluctuate unpredictably. Markets will decline at times, but dividend payments continue even when stock prices temporarily fall.
Repeated consistently, this process quietly builds wealth, while others panic over daily market movements.
Some people argue dividend investing is boring or slow compared to chasing aggressive growth opportunities.
If your goal is excitement, speculation might feel appealing, but excitement has nothing to do with sustainable wealth creation. Real investing is disciplined, repetitive, and sometimes boring, but it delivers consistent results over long periods. The tortoise truly outperforms the hare when measured across decades instead of months. Now, let me explain exactly what I look for when. Without pricing power, rising costs destroy margins, and long-term profitability becomes impossible. Second, I require strong balance sheets with manageable debt and sufficient cash to survive economic downturns. Economic cycles are inevitable, and companies with financial strength always emerge stronger than weaker competitors.
Third, I want a clear competitive advantage that makes it difficult for rivals to take meaningful market share.
That advantage could be infrastructure, regulation, scale, or customer dependency, but it must be durable.
Finally, valuation matters deeply because even the best company becomes a poor investment if purchased too expensively.
They are also exactly how I approach the first stock I would buy without hesitation today. This first pick is often overlooked because it lacks excitement and headline appeal.
However, it generates enormous cash flow, pays reliable dividends, and benefits from economic activity regardless of market sentiment.
The first stock operates in the energy infrastructure space, including pipelines, storage, and transportation assets. Before dismissing this as boring, you must understand why this business model is extremely powerful.
This company does not depend on energy prices because it earns money based on volume moving through its infrastructure.
Think of it as a toll road, collecting fees every day, regardless of public opinion or political debates. All that energy must travel through regulated, capital-intensive infrastructure that cannot be easily replicated.
Building new pipelines is extremely difficult due to regulation, approvals, and environmental constraints.
Cash flows are predictable because customers sign long-term contracts lasting decades. This predictability allows management to plan. As a result, the company pays a dividend yield above 6% annually. That yield is a stable cash flow. Comparable income opportunities with similar risk profiles are extremely rare in today's market. This dividend has been paid consistently and increased through multiple economic cycles. Valuation makes this opportunity even more attractive because market attention remains elsewhere. My approach with a business like this is simple and extremely effective over time. I buy shares, collect dividends. Over years, both income and share count grows steadily. This is not exciting investing, it is disciplined wealth building. Concerns about renewable energy exist, but the transition will take decades, not a few years. As renewable capacity grows, reliable infrastructure becomes even more important, not less. Strong management adapts continuously, ensuring long-term relevance and stability. Over the past decade, it maintains investment-grade credit ratings and manageable debt levels. When sentiment shifts, valuation multiples.
Now that we have covered the first stock focused on stability, income, and infrastructure, let me shift your attention to the second opportunity I would buy without hesitation.
This second stock still pays dividends and maintains strong fundamentals, but it also offers higher long-term growth.
The second stock I would buy without hesitation operates in the healthcare sector, but not in the speculative areas most investors immediately think about.
I am not talking about biotech companies gambling on unproven drugs, nor hospital chains, Polis. I am talking about a healthcare company positioned directly in the path of one unavoidable reality.
This is not a temporary trend or a cyclical pattern that reverses when the economy improves or slows down.
Demographics move slowly, predictably, and relentlessly, which is why they are among the most powerful forces in long-term investing. People may delay buying new homes or cars during recessions, but they do not delay essential medical care when their health is involved. The company I am referring to operates in a critical niche, providing essential products and services used throughout the entire healthcare system. Hospitals depend on these products daily, clinics rely on them, doctors require them, and patients benefit from them whether they realize it or not. These products are not optional or discretionary purchases that hospitals can eliminate during budget tightening or economic slowdowns.
When medical procedures occur, these products must be used, which creates stable demand regardless of broader economic conditions.
Healthcare providers do not switch suppliers lightly when patient outcomes, safety, and regulatory compliance are at stake.
This stickiness creates a strong competitive moat, protecting long-term margins and reducing the threat of rapid market share loss.
From a financial perspective, this company generates substantial free cash flow year after year with impressive capital efficiency.
Its return on invested capital remains strong, indicating management knows how to deploy money profitably rather than chasing unnecessary expansion.
The balance sheet is healthy, debt levels are manageable, and liquidity provides flexibility during economic downturns or industry disruptions.
The dividend yield sits around 3%, which may seem modest compared to high-yield stocks, but growth makes the difference. Dividend has increased steadily over time, reflecting confidence in cash flow durability and future earnings growth.
Unlike high-yield traps, this dividend is supported by expanding operations and long-term demand, not financial leverage or accounting.
What you are buying here is a blend of income today and compounding growth tomorrow, driven by unavoidable healthcare demand. The underlying business expands naturally as the population ages, requiring no heroic assumptions about technological breakthroughs. Now let us talk about competitive advantages, because this is where the real strength of this company becomes clear. First, it has spent decades building trusted relationships with healthcare providers, becoming deeply embedded in operational workflows. When trust is established in healthcare, switching costs become extremely high due to training, integration, and patient safety concerns. Second, the company benefits from massive scale advantages that smaller competitors simply cannot replicate efficiently. That scale allows better supplier negotiations, higher research investment, and lower per-unit costs across its product portfolio.
Efficiency translates directly into stronger margins in an industry where operational discipline determines long-term profitability.
Multiple product lines and service categories ensure stability even when one area temporarily underperforms. This diversification supports consistent dividend payments and reduces earnings volatility during unpredictable market conditions. Now let us address valuation honestly, because not every great business trades at a bargain price. This stock is fairly valued, not cheap, but sometimes paying a reasonable price for quality produces superior long-term results. I would rather own an excellent business at a fair valuation than a weak business simply because it appears inexpensive. Over decades of investing, my worst mistakes came from buying cheap stocks with broken fundamentals, not from slightly overpaying for quality. Cheap stocks are often cheap for good reasons, including poor management, shrinking markets, or declining competitive relevance. This healthcare company does not suffer from those problems and instead offers visibility, resilience, and long-term expansion potential. Personally, I am building positions in both of these stocks because together they create balance across income, growth, and sector exposure. The energy infrastructure stock provides stability and high yield, while the healthcare stock delivers compounding growth supported by demographics.
Combined, they form a foundation capable of weathering recessions, volatility, and shifting market narratives.
Many investors ask why I am not concentrating entirely on technology, artificial intelligence, or the latest innovation trends. Technology offers opportunity, but crowded trades, inflated expectations, and stretched valuations increase downside risk dramatically. I prefer building a foundation with cash-generating businesses that will exist regardless of which trend dominates headlines next year. Once that foundation exists, selective growth investments become optional rather than necessary for financial survival. Most investors reverse this order, chasing excitement first and stability later, often learning costly lessons along the way.
That approach leads to emotional decisions, panic selling, and starting over after market downturns.
These two stocks represent discipline, patience, and realism rather than speculation and hope. I have lived through multiple market crashes, watching portfolios swing dramatically without losing conviction. If this strategy resonates with you, do your own research and study these companies carefully. Understand their financials. We are building a community focused on real investing, long-term thinking, and disciplined wealth creation. Leave a comment, share your perspective, and continue learning, because wealth is built one smart decision at a time.